Hello and welcome to the ETF Show. Joining us now to talk about the newest loan ETF, the impact of a Fed pivot, and much more is Jake Lemle, Managing Director, Portfolio Manager, and Head of Loan Trading and Capital Markets at Eaton Vance. Well, Jake, it's great to have you with us. For starters, could you share more about your career path, who Eaton Vance is, and what you do there?
Yeah. Hi, Jenna. Thanks for having me. So we at Eaton Vance, we're coming up on our 3-year anniversary of our marriage to Morgan Stanley after being acquired in 2021. I'm guessing Eaton Vance is probably a familiar name to many of your watchers, but for those that don't know us, we're a global asset manager headquartered in Boston, Mass. And one of our key areas of expertise is in credit. And really we're a pioneer in managing high yield loans and bonds at the outset of those markets. Some of our flagship funds have track records dating back to the late 80s. More specifically, what do? I'm a senior portfolio manager on a range of different strategies, and I also run our trading and cap markets effort for the loan business. So I grew up trading, which really forged my skills in managing risk and asset positioning and in portfolio construction. So what we at Eaton Vance really specialize in is active, fundamental credit management. And I've spent my career helping build and grow out this capability as the market has evolved and matured into what's now a $1.5 trillion asset class.
And how would you describe the opportunity in your asset class right now? And would you say this is an attractive environment for investors to allocate to senior loans?
I really believe it is. I've been telling anyone to listen for a while now, over a year plus, but I think the world is just massively underweight credit, and the huge yields are just impossible to ignore. So the Morningstar Leveraged Loan Index, one of our main trackers, put up a 13+% return last year in 2023. And the vast majority of that came through current income, which are secured by the assets and cash flows of what are really large, mainly U.S. companies. If you pull up any of our fund holdings, you'll recognize many household names, many market leaders in their respective industries. So yeah, the loan index is currently yielding 9 or 10%, depending how you want to measure it, which is kind of 2x the yield you're going to get on the Barclays Agg. So loans also have the feature of no duration. You don't have to take a view on interest rates, when the Fed's going to cut, how much they're going to cut, right? So floating rate in your portfolio can be a really a nice diversifier, which has proven out through time. You don't have to sit around and guess what Jay Powell ate for breakfast. I don't know. Long story short, reserve monetary policy is over. Tina's left the building. It was a good 15-year run, but now I really believe we're in the earlier innings of what can be a new regime where investors can make real, meaningful equity-like returns.
Building off of that, Jake, with the Fed on the verge of pivoting to lower rates, how does this factor into the equation for floating rate products?
Yeah, it's a fair question. But first off, I think we should probably admit that forecasting where rates are going is just a form of gambling, right? The forward curve and the Fed dot plot. I mean, these things are wrong essentially 100% of the time. So, but back to the floating rate loan market, let's just remember where we're starting from. 9, 10% unlevered yields at the index level in what's a benign credit environment. So these are by far the juiciest numbers we've seen in my career. It wasn't that long ago we were earning 3 or 4% when Fed fund rate was 0, and for a similar level of risk. And when the Fed cuts, I guess we can say when. Yes, it'll shave some of that coupon down, And another thing to point out is maybe that when the Fed does start cutting, that's obviously stimulative to the economy. It's a positive for credit and all risk assets, really. It'll be a boon to our issuer base, and who will see their debt service costs decline and the underlying economic business activity pick up across the board.
Now, the Eaton Vance team has been investing in the loan asset class for a long time. What makes your investment process different?
Yeah, so plain and simple, we have the expertise. We've got the process. We've got a huge, deeply experienced research team doing fundamental credit analysis. So it's an intensive credit culture where we're focused exclusively on the loan asset class. A lot of our competitors have a more centralized research function where different sectors come and tap into it. But I really believe that our structure is a big competitive advantage. And everybody knows what team they're playing for, and we've all been playing together for a long time. Credit investing is really about avoiding trouble, right? It's about knowing the names. It's about being able to see around the corner and anticipate problems to live in the future, right? So be it at the issuer level or a broader sector call, we really feel like we tend to see it coming. So we also actually have the capabilities to broaden the opportunity set to some adjacent sectors with allocations to high yield bonds and CLOs. And these tend to be sources of real alpha over time. But long story short, being active is the key, and it really pays off in our market.
Finally, Jake, let's talk about EVLN, or EVLN as some like to call it. It's the newest loan ETF, but in many ways it probably doesn't feel new at all because EVLN taps into the same team and investment platform that underpins your longstanding mutual funds. Now, how does it compare to similar ETFs? What's the expense ratio? And what else should investors know about EVLN?
Yeah, you've got it exactly right. We've had clients asking us for an ETF for years and years. So we're finally just giving the people what they want. It's the same team. It's the same investment style and discipline investors know us for, just in a new wrapper. I'm really excited about EVLN. And when you scan the existing ETF landscape, I'm very optimistic we can win. We just talked about how passive doesn't work. The passive strategies also have high expense ratios. Ours is lower at 60 basis points, believe it or not. And the key is that we at Eaton Vance are true loan market experts. And this is an active strategy that highlights all of our best ideas.
Well, Jake, thank you so much for joining us.
Thanks so much for having me.
And thank you to everyone watching. Once again, that was Jake Lemle, Managing Director, Portfolio Manager, and Head of Loan Trading and Capital Markets at Eaton Vance. And I'm Jenna Dagenhart with Asset TV. Before investing, carefully consider the fund's investment objective, risks, charges, and expenses contained in the prospectus available at eatonvance.com. Read carefully.